When markets suddenly fall and red candles appear everywhere, something powerful happens inside the mind of a trader. Prices drop quickly, charts turn red, news headlines become dramatic, and suddenly many traders feel an intense urge to act immediately. They want to sell, they want to exit positions, they want to protect themselves from further losses. This reaction is known as panic selling, and it happens in almost every market cycle. But here is something important that many traders eventually learn. Panic selling is rarely the right choice. In this video, I want to explain why panic selling happens, why it feels so convincing in the moment, and why disciplined traders approach falling markets very differently. Because when markets fall, the biggest battle is not between buyers and sellers. The biggest battle happens inside the trader's mind. If you stay with me until the end of this video, you will understand why panic selling happens, how professional traders think during falling markets, and what mental habits help traders avoid emotional decisions when prices move aggressively. And if you want to strengthen your trading mindset and develop the discipline required to survive volatile markets, consider subscribing to Bull Mindset. This channel focuses entirely on trading psychology, emotional discipline, and the mental frameworks that help traders remain calm when markets become unpredictable. Now let us begin with something very important. Panic selling is an emotional reaction. It is not a strategic decision. It happens when traders feel fear and urgency at the same time. The mind begins thinking that the situation is dangerous. The trader believes that if they do not act immediately, they will lose even more money. This creates a powerful urge to sell quickly. But this emotional reaction is not random. It is connected to the way the human brain responds to perceived threats. The human brain evolved to protect us from danger. When the brain detects something that appears threatening, it activates a survival response. Heart rate increases, breathing becomes faster, attention becomes focused on the threat. This response helped humans survive dangerous environments in the past. But in financial markets, this same response can cause traders to make impulsive decisions. When prices fall quickly, the brain interprets the situation as danger. The trader begins thinking about loss. The mind wants to escape discomfort, and selling feels like the fastest way to stop the emotional pain. But there is a problem with this reaction. Financial markets are not always logical in the short term. Prices can fall rapidly because of fear, but those movements do not always represent long-term value. When traders panic sell, they often exit positions at the exact moment when fear in the market is at its highest. Now let us talk about something important: market cycles. Financial markets move in cycles of optimism and fear. There are periods when investors feel confident. During those periods, prices rise. Then there are periods when investors become nervous. During those periods, prices fall. Panic selling often happens near the peak of fear in the cycle. At that moment, many investors feel convinced that the decline will continue indefinitely. But historically, markets rarely move in one direction forever. Even during strong downtrends, there are temporary recoveries. Professional traders understand this psychological pattern. They know that fear can exaggerate price movements. Instead of reacting emotionally, they observe the market calmly. Now let us talk about another psychological factor that influences panic selling: loss aversion. Loss aversion means that losing money feels more painful than gaining money feels rewarding. For example, losing $1,000 usually feels worse than the satisfaction of gaining $1,000. This emotional imbalance can influence trader behavior. When traders see losses growing on their screen, the emotional pressure becomes intense. They want to stop the pain immediately. Selling feels like relief, but this relief is temporary because panic selling often happens without careful analysis. Now let us move into real trading examples. Imagine a trader holding a position during a sudden market decline. The chart turns red. The position becomes negative. The trader begins feeling uncomfortable. Fear appears quickly. The trader thinks the market will continue falling, so they close the trade immediately. But later, the market stabilizes. The price begins recovering. Eventually, it returns to the original level. The trader realizes they sold during the worst moment of fear. Now imagine another trader in the same situation. This trader also sees red candles. They also feel emotional pressure. But instead of reacting immediately, they pause. They check their trading plan. They evaluate their stop-loss level. They remind themselves that volatility is normal. Sometimes the trade still fails and reaches the stop-loss. But sometimes the market recovers and the trade works. The key difference between these two traders is not intelligence. It is emotional control. Now let us talk about another scenario. A trader opens the platform and sees red across multiple markets. Stocks are falling, indices are falling, crypto is falling. News headlines talk about crisis. The trader assumes the market will continue collapsing. They sell aggressively, but shortly after that, the market begins recovering. This situation happens often because markets frequently overreact during moments of fear. Professional traders understand this tendency. They know that emotional crowd behavior can push prices beyond reasonable levels. Instead of joining the panic, they observe carefully. Now let us talk about the mindset difference between emotional traders and disciplined traders. Emotional traders react quickly. They see falling prices and assume the worst. They make decisions based on fear. Disciplined traders slow down. They ask questions before acting. Is this movement part of normal volatility? Has my stop loss been triggered? Am I following my strategy? This pause creates clarity, and clarity protects traders from impulsive decisions. Now let us talk about mental frameworks that help traders avoid panic selling. The first framework is acceptance. Losses are part of trading. Trying to eliminate every loss creates emotional pressure. Professional traders accept that some trades will fail. This acceptance reduces panic. The second framework is probability thinking. Trading is a game of probabilities. One trade does not define success or failure. Professional traders evaluate performance across many trades. This perspective helps them remain calm during temporary declines. The third framework is risk management. Before entering a trade, professional traders define their maximum acceptable loss. Because the risk is defined in advance, they do not panic when price moves against them. They already know the worst-case scenario. Now let us talk about practical exercises that help traders control emotional reactions. One simple exercise is the pause rule. When you feel the urge to panic sell, pause for 10 seconds. Take a breath. Ask yourself one question. Am I following my trading plan, or am I reacting to fear? This short pause can prevent impulsive decisions. Another helpful exercise is breathing control. Stress often causes shallow breathing. Slow breathing helps calm the nervous system. When the body relaxes, the mind becomes clearer. Another useful habit is journaling. Writing down emotional reactions after trading sessions helps traders recognize patterns in their behavior. Over time, this awareness strengthens discipline. If this video is helping you understand the psychology behind panic selling, consider subscribing to Bull Mindset, because mastering emotional discipline is one of the most powerful advantages a trader can develop. Now let us talk about long-term perspective. Markets have experienced many declines throughout history: financial crises, economic recessions, geopolitical conflicts, pandemics. And yet markets continue functioning. Prices fall, prices recover, cycles repeat. Traders who maintain long-term thinking remain calmer during temporary market declines. They understand that panic selling rarely creates consistent success. Now let us move toward the final message: control. Traders cannot control market movements. They cannot control economic events. They cannot control global uncertainty, but they can control their reaction. They can control their discipline, they can control their risk management, and they can control their mindset. This control separates emotional traders from professional traders. Let me leave you with a final thought. Panic selling feels logical in the moment. Fear makes it feel necessary. But most of the time, panic selling is not a strategy. It is an emotional escape. Disciplined traders understand this. They remain calm, they observe the market, they follow their plan, and they make decisions based on analysis rather than emotion. Stay patient, stay disciplined, and remember that the strongest traders are not the ones who react fastest. They are the ones who remain calm when others panic. And if you want to continue building that mindset, subscribe to Bull Mindset. I will see you in the next video.